the Trust the Plan podcast. I'm Nick.
And I'm Jim.
And Jim, we're a few weeks into football.
Yeah.
And we got some interesting things happening in the Big Ten. Right? Who's going to make it to the Big Ten championship game?
Other than Michigan? We
I'll put you on the spot.
Michigan, right?
Yeah, put you on the spot.
I mean, I think Ohio State's always going to be. It was always going to be tough. They, they look decent again this year. Yeah, I tell you, Indiana's been a surprise too, though, haven't they?
They have, and I don't think Ohio State plays Oregon or Indiana.
Oh, so they might have an easy path.
Indiana doesn't play Michigan, but they do play Penn State. So I was thinking the winner of the Oregon-Indiana game might find themselves in the Big Ten championship.
Okay.
And the winner of Ohio State and Michigan could be in there.
With the other one.
Yeah. Ohio State still has to play Penn State, and that's it. Penn State and Michigan, and that's it.
Yeah, yeah. It's not too bad.
Yeah. And then, let's see, who else? Illinois was exciting, then they fell off. Washington looked pretty good against Ohio State in the first half, but then they fell off.
Yeah.
So, yeah, it's Indiana who's, continuing
They're kind of the
surge.
dark horse here, yeah.
They're continuing the surge. Oregon's good as expected. Penn State, they don't scare me. We don't play them. Michigan doesn't play Penn State again this year. But that loss to Oregon,
yeah,
unless they beat Ohio State,
yeah, that's gonna put them behind for sure.
yeah. I mean, they could sneak in if they beat Ohio State and then Ohio State beats Michigan, or if Michigan beats Ohio State, like last year, Penn State backed in.
Yeah.
It could happen again. Could be Oregon versus Penn State again. Anyway, Michigan's looking better, so feel better about the team, and I could see us, tripping up another, and then Ohio State. So,
yeah, still some growing pains, but overall, the reasons to be optimistic.
Another one of the surprises, which is just baffling to me, is how bad Wisconsin is.
Yeah, yeah, they've had a long history of being a pretty solid program, and they've really fallen off here, haven't they?
Yeah, it reminds me, they terminated the coach. I forget his name. Chris
Bielema?
No, he left. But after Bielema, Chris something.
I don't know.
They fired him, just like when Lloyd left, and just like when they fired the Nebraska coach. It like sent years of shockwaves through those programs. So tough sledding. Anyway, so we're talking about taxes today. There's a Wall Street Journal article from today talking about ways with the new tax laws for next year, or even this year, you could find yourself in a 0% tax situation.
Oh,
pretty interesting,
yeah.
huh?
Let's hear this.
Yeah, so if you can see the screen here, if you're listening on Podbean or Apple Podcasts or Spotify, check us out on YouTube. You have the visual. So Jim just got a haircut, and so looking good over here. All right, so married couple with 2 kids, how could we be paying zero tax? So let's walk through it. We have $100,000 of wages. We're adding to the 401, the HSA, the flex spending accounts. So we're buying our wages down by taking advantage.
Pre-tax contributions, yeah.
Absolutely. So we're only showing the IRS 82. Then we're taking the standard deduction, and these 100,000 of wages include some overtime. And so you're able to take out half the overtime on a below the line deduction, and now you're all the way down to 40,000, which would only be a tax of 4,000, and then you have the child tax credit, which takes it to 0. So in this case, the higher standard deduction, that's nothing new. It's been around for a while. The overtime deduction really helps, and then I think the child tax credit sneaking in there helps them a lot as well. They're paying zero tax, so it's a pretty good situation.
Yeah, absolutely.
So if you have a setup like this, pay attention, okay? Talk to your tax advisor, do some tax planning, make sure you're taking advantage of these opportunities. Now, another one that's, that they're highlighting because of the tips, right? The first one, we're highlighting the overtime situation. In the second example, a single server with a child. So there's $46,000 in wages and $12,000 in tips. So the way this works, she's going to contribute a little bit to an IRA, and that comes off the top. Then you have the standard deduction, and then the full tip deduction, which is, pretty nice, brings the taxable income way down to $21,945, and so there's a tax, But then there's a saver's credit from the IRA contribution, and the child tax credit comes back in again to take us down to zero. But let's face it, how many of those tips were we claiming in the first place?
Well, that's to be determined. But yeah, the fact that you can now include it though, get some benefit, higher income for your Social Security calculation.
That's right.
But then get that deduction to bring it back down is pretty nice.
Jim, back in 98, 97, 96, 97, 98, when I was a busboy at Chi-Chi's, I would get tipped out by the waiters and waitresses, and that was cash. But my W-2 was $2.45 an hour. But I would probably make $10 an hour in tips back then, which was fantastic. But what they would tell you, and this is like way long time ago, so I don't think it's I don't think they can turn over
anymore.
Yeah, it's past the statute. Okay, but the minimum wage back then was like $4.25, and so what everyone would say was, well, you have to claim $2 an hour in tips to get you over the minimum wage, and then you're good. So basically, that extra declared wage or that declared tip meant that your paycheck would just all go to tax, pretty much, but then you had all the cash.
Yeah.
So that's how that worked. So a lot of people are not claiming these tips, I know from experience, and so this kind of puts it on an even playing field. Do I think that the people will continue claiming them or doing it the way they were? Probably will just do it the way they were. So anyway, okay, now what if we have a married senior couple? So we have a lot of different stuff going on here. Pension income, a little part-time wages. We talk about that a lot. Yep. At 8,000, it sounds kind of like a Walmart greeter situation. We'd like to talk about semi-retirement and a high hourly consulting rate instead. Yeah. A little bit of bank interest for 2,500. Social Security of only 12,000. That is.
It's like only one claimant, maybe. Maybe they're waiting.
This is an unreasonable situation, right? And then,
they're living off. It looks like they're living off the portfolio though a little bit, right? Maybe they're living off the portfolio and delaying one of them.
Yeah, you're right. They're delaying one of the Social Securities because this Social Security is just too low, and then they have a big portfolio because they're locking in capital gains of 25,000 and dividends of 25,000. So we're showing 98. Okay, so it's a reasonable living. And we're taking off the non-taxable Social Security, which is only a little bit of it, and then the standard deduction, and then the senior deduction, which is $6,000 each. So that's people over 65 this year. Okay, so that's the way the administration basically was saying no tax on Social Security.
Yeah, I think that's important to comment on because that's what most people think is that my Social Security won't be taxed, but in reality, you're just getting an extra deduction.
And a deduction is not the same as a credit.
Yeah.
But in this case, we're going to have some exciting news. So they take that $96,000, take off the standard deduction and the senior deduction, brings it down to $50,000. Now, if you're showing, I believe, less than $94,000, then you're in the 0% capital gains and dividends bracket. Which is something that I dream about. Okay.
This kind of goes back to last week's podcast too, where we talked a little about the Benny IRAs and adding to the taxable accounts instead, because it can be tax favorable, right? The capital gains can come out.
That was a banger. You should go back and listen to that one.
Yeah, you got to hear that one. But those capital gains can come out pretty attractive if you're retired or have low income.
Here's my other prediction here, okay? Even though these people clearly are following the rules and getting to a zero tax, someone's going to screw it up, trying to do it on their own or using someone who's not a real CPA, and probably they'll end up paying some tax. What do you think?
Yeah. We've said many times, a good CPA will,
worth their weight in gold.
There you go. They're worth the money. Yep.
Definitely. Okay, so if you are in a situation where you think you could be in a 0% tax bracket, but you look at last year's taxes and you're paying thousands, well, give us a call. Let's have a second opinion. You can reach out to us at peakwm.com. And also, if you're watching on YouTube, please ring that bell, subscribe, and like it. And if you like the topic, share with your friends.